A few days ago, I made a video on a 3 ETF portfolio that I think would be perfect in today's economic environment, one that will allow investors to capitalize on this insane AI momentum while also managing risk exposure in case of a potential recession. I explained everything in detail, so if you haven't seen that video yet, I highly suggest that you do, and you can check it out right here. Now, the fundamental strategy behind my choices was focusing on ETFs that produce high levels of income while balancing sector allocations through diversification with big tech, value, and fixed income bonds. I want you to remember this as we move through the video. As we all know, diversification is crucial when it comes to minimizing portfolio risk. And high-income ETFs like covered call ETFs are able to smooth out portfolio volatility, serving as another avenue of minimizing portfolio risk and volatility. The high levels of income they provide are able to counteract a drop in stock price, while also serving as a great way to dollar cost average into investments that go on sale. And for those who aren't familiar with covered call ETFs, these are investments that sell call options against their underlying holdings in order to generate premium income, which is then distributed to investors in the form of a dividend. Now, a lot of these ETFs are either selling call options on the S&P 500 or the NASDAQ 100. But there are some ETFs that have taken an entirely new approach to the covered call strategy. There's one ETF that has been able to accumulate almost $500 million of assets under management in 1 year that provides a monster dividend yield of 25%, which is insane. Now, before we continue, I wanted to let you guys know that I just released a free dividend ETF cheat sheet that breaks down the 7 key metrics every smart investor should know, plus my #1 way to spot a dividend trap. You can grab your free cheat sheet by clicking the link in the description or comment section below. And this brings me to FEPI, which is the Rexfang Innovation Equity Premium Income ETF. So to begin, let's run through the fundamentals of the ETF so that we can get a better understanding moving forward. This ETF was established in October of 2023. The ETF has an expense ratio of 0.65%, which is higher than the JP Morgan ETFs. However, you have to keep in mind that JP Morgan is able to provide lower expense ratios because of their size and reputation. But with FEPI's 25% dividend yield, the expense ratio is practically negligible. All right, now this is where things kind of take a turn, so I want you guys to pay very close attention. Notice how despite the dividend yield being almost triple that of JEPQ, their total returns are practically the same. This immediately shows you that the ETF doesn't provide as much capital appreciation and is instead trading growth for income. And that is why its net asset value has not been able to grow like JEPQ. You can see when looking at the price return of the ETF that it is heavily lagging behind. Now, aside from ETFs, when it comes to portfolio construction, I like to complement my allocations with individual stocks as well. One of my favorite tools for this is ProPix AI. This feature builds model portfolios based on different strategies, and it is designed to outperform benchmarks. And there are many powerful portfolio options you can choose from, such as tech titans, Warren Buffett's top 15, healthcare heroes, small cap sprinters, or the S&P 500 value portfolio. Every portfolio includes a detailed breakdown of each stock's financial health, earnings, cash flow, valuation, and even timestamps of when the position was opened or closed. I'm very excited to share that investing.com has officially extended their Cyber Monday sale, where you can get up to 55% off their plans. And if you use my link, you will get an additional 15% off on top of that, which means you can get up to 70% off. Investing Pro gives you access to a massive database of global stocks and ETFs, which is backed by deep financial data, research tools, portfolio analytics, and both technical and fundamental insights. You'll also find portfolios from top fund managers like Ray Dalio and Warren Buffett, which you can analyze or even replicate directly inside the platform. As always, past performance is not indicative of future results, and this is not financial advice. I am simply sharing one of the tools I personally use to enhance my own research. Another one of my favorite features is Warren AI, which is like their version of ChatGPT, but with access to a real financial database. So when you ask it a question, the response isn't just surface level, it is backed by actual data and analytics from their system. There's a lot to explore inside the platform, and if you'd like to check it out, you can use my link or code VictoriaMedia to get an additional 15% off, for a total savings of up to 70% off. So how does FEPI work? Well, FEPI and JEPQ are actually very similar. FEPI is a covered call ETF that tracks a selected universe of stocks while selling out of the money calls to capture income. The fund managers are actively selling call options at strike prices that are above the current trading prices of the underlying stocks, and typically with expirations of 30 days. And the premium income they collect is being distributed as a dividend yield. Now, I'm not exactly sure how far out of the money these calls are sold, but the fact that they are sold out of the money means that the ETF is able to capitalize on some growth as well. This is very important, and I've always said that ETFs that sell out of the money call options are superior to those that sell at the money call options, because they're able to capitalize on both income generation and growth. Now, the fund managers do have the flexibility to choose how far out of the money they will sell these call options, and it really depends on their input. But one thing's for sure is that this ETF is likely using a large portion of their assets to sell these call options. Going back to their total returns, remember that the price appreciation of FEPI was a fraction of JEPQ, but its dividend yield is almost triple of JEPQ's. But the biggest difference between these two ETFs is their underlying holdings. When you look at FEPI's holding breakdown, you see a very concentrated exposure to technology, and then a much smaller allocation to only two other sectors, which are communication and consumer cyclical. This is much more concentrated than JEPQ, which is only 50% of its portfolio allocated towards technology, but also with a lot broader exposure to a variety of other sectors. But the most important thing to note here is that the top 10 holdings of FEPI make up more than 70% of the portfolio. And when you look at the fund's prospectus, the ETF only holds 15 of the top tech stocks, and they are all equally weighted. This includes Apple, Nvidia, Microsoft, Salesforce, AMD, Netflix, Meta, etc. So this is a major concentration issue, which leads me to my biggest problem with the ETF. Here's why. You see, high-income ETFs, in my opinion, must serve two purposes, and that is to generate high income and minimize volatility. Now, the reason these two must be satisfied is strictly because high-income ETFs always fundamentally underperform the overall market. When you're trading capital appreciation for income generation, you will never outperform in the long run. But the trade-off for lagging growth is the ability to minimize volatility. That is why JEPQ will always lag behind the QQQ. But it is able to minimize the volatility of the QQQ by around 50%. But when you have an ETF like FEPI that is so concentrated in only 15 stocks, the aspect of minimizing volatility is not being satisfied. The high concentration works against any benefits that you'll receive from the high income. If any one of these holdings suffers from a poor earnings call or some black swan news that could wipe out billions of dollars from their market cap, that impact will be heavily reflected in an ETF like FEPI. Remember that each holding makes up around 7% of the ETF. Now, if you look at its recent performance, FEPI and JEPQ sold off a decent amount, but FEPI saw heavier downside volatility. Now, here's what makes it even worse. You see, if you were to compare the performance of these two ETFs to a benchmark index, that would be the QQQ, just like you would compare SPYI to the S&P 500. JEPQ will underperform the QQQ in a bull run, but it will outperform in a downward trend. The bear market of 2022 gives us a clear depiction of this. But FEPI actually suffered more downside volatility than the QQQ. And it is still lagging behind in the overall bull run. So you see, because of the concentration issue, not only is it lagging behind because it's trading growth for income generation, but its downside risk is even more than the underlying index. And that should not be happening. Now, of course, if we look at the flip side, the exponential growth of these big name tech stocks will work in favor for FEPI. That is why it was able to outperform JEPQ in this bull run. But the outperformance was not very significant for you to expose yourself to heavy concentration risk. FEPI is not providing risk-averse exposure. In fact, at times it could be even more riskier than the QQQ. But without a doubt, had the ETF been around in the bear market of 2022, it would have underperformed the QQQ by a lot because of its heavy allocation towards Tesla, Nvidia, and Netflix. These guys fell 69%, 50%, and 51% respectively. Again, always circle back to what I said in the beginning. High income ETFs must serve two purposes, and that is to provide high income and minimize volatility. But FEPI unfortunately seems to only satisfy one of them. So it's very important to remember that when you're seeking a high income ETF, those that hold a larger number of stocks and have decent diversification will always be a better option in my opinion. High concentration will work against all the benefits of high income, which is not what you want. That is why I've been against yield max ETFs, which use covered call strategies on single stocks. All they do is underperform in a bull run, but capture the same downside risk as the original stock itself, which frankly makes no sense. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit the thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult